Thanks for watching. We appreciate you. Please, please subscribe.
Taken over by the federal government, including Signature Bank, based here in the city.
Fordham Law Professor Richard Squire, who teaches business law, corporations, and bankruptcy, joins us now to look at this issue. So welcome, Professor. Thanks for being with us.
Good morning, Hazel. It's nice to be with you.
Yeah. Our viewers are just wondering, do they have anything to worry about their own banks?
I don't think so. I think as a general matter, it's always good advice that you shouldn't have more money in your checking or your savings accounts than the $250,000 FDIC insurance limit. It's just if you have more than that, you should diversify. You should put all your eggs in one basket. I think the two banks that you just mentioned that are now in receivership made that mistake. They didn't diversify. They put their eggs all in one basket. And so we should learn from their mistake. But if you have your money in an FDIC insured bank, which I'm sure most of your viewers do, and you cap it at $250,000, I think you'll be safe.
Well, Professor, there are experts who say the government should come up with more reserve money, to send the message that other bank depositors, they'll be helped if necessary, and that the Federal Reserve has to stop raising interest rates to fight inflation. We know that after 2008, the bigger banks brought on more reserves to kind of weather this type of storm. I mean, what is actually necessary to prevent more of these bank failures?
No, I think that's right. I think that there is a squeeze that the banking sector is now experiencing. As you said, the Federal Reserve is raising interest rates to fight inflation. And that puts pressure on banks in two ways. It makes deposits a little bit less attractive because, as I'm sure you know, your checking and savings accounts don't pay much interest. And so now if interest rates are higher, you may be able to get a better return elsewhere. At the same time, loans and investments that were made by the banks when interest rates are lower don't have as much value when interest rates are higher. So there is a bit of pressure on banks, and those that did not diversify, and the two that you mentioned are like that, are maybe not going to be able to survive that squeeze. I think it is important for the government to make clear, however, that banks are expected to keep adequate reserves and not to not to take risks that are not hedged. And this rate increase was a long time coming. Lots of people saw it coming, and it's very surprising that the risk managers at these banks in particular, especially Silicon Valley Bank, just didn't adjust for that. With that said, I do think that the new lending facility that the Federal Reserve has put in place to enable banks to borrow against some of those assets, those loans and treasury bills that have lost some value, but they can now borrow against them and raise liquidity. And I think that will shore up bank balance sheets.
I mean, I think a lot of our viewers are sitting there going, what really happened here? And who's at fault? And why did this happen?
So I think that we can talk about who specifically is at fault in terms of these banks. And like I said, I think that there was some recklessness done in terms of how they were managing their risk. But I also think that we do have a financial system in which our government in certain times wants to stimulate the economy and maybe offset some of the borrowing that the federal government is doing when, for example, in the pandemic, when there was lots of spending to try to give people COVID relief. That caused a huge amount of cash kind of enter into the economy. And then that cash needs somewhere to go. So it all ends up in risky investments. But then that produces inflation. And then the Federal Reserve tries to reverse the process and bring the cash ad economy to fight inflation, but that then can put pressure on banks, and some don't make it. So I think there is some fault also with the Federal Reserve System that does this monetary intervention. And we have these big swings in interest rates and the monetary base and have casualties.
All right. Fordham Law Professor Richard Squire, thank you so much for being with us. Of course, it's a complicated issue.
Yeah.
It ain't easy, folks.
No, it's not.
My
Thank you
pleasure.
again. All right.
Thanks for watching. We appreciate you. Please subscribe.